Michael Pond, Barclays head of global inflation-linked research, is here to talk a bit about the inflation and fixed income outlook, as well as the economy. Michael, good to see you. We obviously are expecting, based on the consensus, just a little bit of a pause in this disinflation move in terms of core PCE that we've seen for a while. But we also have Atlanta Fed President Raphael Bostic overnight in a speech essentially almost declaring victory, saying if you took out the lagging shelter components of inflation, we're almost at target in terms of core CPI as well as PCE. Where do you come down on this idea that inflation is already largely taking care of itself?
Well, we do think it'll pause, and we actually think we'll get a bit stronger number in the core PCE, especially in the super core. So stripping out shelter within services, we actually think it will come in at a fairly strong 0.5, which is not going to leave the Fed with an impression that they're making continued progress. That inflation, while down from its peak, is still too high. So even Atlanta Fed President Bostic's comments, while the market is taking it as a bit dovish, he indicated that he thinks, again, he's one of the more dovish members, he thinks that they'll be on hold at a high level of rates for quite some time. The market is pricing in cuts as early as the beginning of next year. So we think the market is still bearish relative to the outlook and not fully getting the message that the Fed is keeping at it. That's really been the message since Jackson Hole 2022. That was reiterated at Jackson Hole 2023. And we think that the Fed will remain on the hawkish side until inflation really does come down much further towards target.
I grant that, the Fed funds futures market does start to price in some cuts out there. But does that, in your mind, mean that most investors genuinely expect there to be cuts, or is that just kind of the way we manage risk in this economy? The Fed's almost done, so the next significant move is likely to be a cut, or at least we want to have a just-in-case trade on in the event that the economy weakens.
Yeah, I think that's a really important point about how markets price. Markets don't just price for baseline scenarios, and if they're just above 5. If you think there's a chance of 0 by the end of next year because of some absolute crisis, well, there's probably not much of a chance of 10%. So again, if you're leaning, are rates going to be 5% higher or 5% lower? Chances are they'll be 5% lower. But we think that the market is still priced for too much confidence, too much risk of that downside scenario. And we think real short-end real yields are poised to continue to move higher as they have been.
Right. What do you make of the fact that we did see a pretty significant rally in Treasury, so yields coming down over a couple of days, based on arguably some secondary economic inputs, right? You had the JOLTS number, which of course is widely watched, but never was front of mind, and then the ADP payrolls data. Does that just tell you we were wound pretty tight, expecting hotter numbers? Yeah,
the market did sell off pretty hard over the prior weeks, and so was probably due for a bit of a pullback. But today and tomorrow, especially tomorrow, is the main show when it comes to the data. ADP and the JOLTS data are certainly good leading indicators, but tomorrow's employment report, payrolls, but also average hourly earnings. The wage growth has been strong. We think it'll continue to be strong in tomorrow's number, up 0.4, and that payroll growth will continue to be too strong for the Fed to believe that inflation will come in consistent with its 2% target. We're expecting 200 print on the headline payroll print tomorrow.